everyone. It's 5 p.m. on the clock, which means it's time for our Rise with India Prime Time. And as always, we will do so, or rather we'll kickstart the show with the Money Show, which is your one-stop destination for all your money-related matters. Whether you have questions on how to earn more, whether you have questions on how to invest all that money that you're earning now, or for that matter, how to save money and how to spend it wisely, this is your one-stop shop. Today, here's what we have lined up for you on the show. SEBI last week restricted mutual funds to invest only in listed companies. What does that mean? As SEBI tightens the nose on what MF managers can do and cannot do you think your returns may be impacted? If you have such questions, send in your queries, and of course, we will also get our special financial expert for today to prune your portfolio. So keep your questions and queries ready. Numbers appearing on the top of your screens. Also, real estate. The Supreme Court has dealt with that with a firm hand. They've upheld the home buyer's status as a financial creditor. What exactly does it mean, and how big of a relief, or rather how big a breather is it for home buyers? Today, that's what we will be discussing on the Money Show. The big news that we are addressing that came out last week, and that is SEBI's continued efforts to regulate mutual funds in a much higher manner. They've asked mutual funds to invest only in listed securities. Do remember, just about, I think, a month or 2 months ago, they had also asked liquid funds to keep a certain amount of money in cash, certain amount of money in only highly rated securities. But the question is, does greater regulation mean limited returns? Let's talk about that and more. And of course, to answer all your portfolio-related queries, I have with me Kalpesh Ashar. He is a certified financial planner. Kalpesh, thank you so much. It's always good to bring you on board on the Money Show. This is, of course, the latest diktats from SEBI. And I think in the last 3-4 months, they've really been cracking the whip on mutual funds. And a lot of our viewers themselves are investors in mutual funds. It's a very easy product. So naturally, it's a question that a lot of our viewers may be having. Restricting investments only to listed securities, be it in equity or in debt. So firstly, explain to our viewers that on an average, a regular mutual fund, does it really have a very big quantum in the first place of unlisted securities?
So as per the quantum which you are asking about it, there is a certain space which is allowed as per mandate, which was there earlier. Now, how much and up to what extent, a fund manager as per his rationale goes into that space is completely his rationale to, deliver better returns and also consider risk with it. Now, what has happened over the past is known to all of us, that in the recent past, we've seen that there's been a slew of, I would say disasters which have happened in the debt fund space, and that is really alarming for the retail investors.
Yeah.
And obviously, we would find that the regulator who is in charge of the investor protection, which is SEBI, has to take some strict steps, and they did. So the clampdown which they did was resulting in all these measures which we are seeing. That the first thing they've said is that although in a very, I think, phased out manner and in a gradual manner, they are going to shift all the unlisted securities in debt and in equity completely to the listed space. Now, what does that mean for the mutual fund investor? If you ask me, I don't really, think that even in the unlisted space, when the going was in that, I would say, era.
Yeah.
Okay, that the fund managers, because of a certain holding in some unlisted space, they were able to gain any monumental returns for the fund scheme as per, whatever the alpha generation is.
Okay.
So I really don't think that had a bit of thing. It could add a kicker. It could give that small booster dose to the overall portfolio. But as it is, the proportion was not very high. And the other thing which we need to know is it's not only the shifting from listed to unlisted. It's also the amount of unrated debt securities, which has been brought down from 25 to 5%.
Yeah.
So that is a major thing, but it has to be done in a phased out manner. It cannot be brought down in a fix or at a shot. So we need to understand that. But surely this is a very, very positive move, and I think long in the waiting, this was overdue. And now I think people will feel a little bit more secure, the retail investors. Although I do not know about the fund managers, they might find themselves a little
restricted,
bit restricted.
Limited.
But I think the retail investor interest is protected.
But Kalpesh, see, as a retail investor, I know that I want to invest in a mutual fund, and I know that certain risks come along with investing in a mutual fund. Equity, debt, of course, debt is relatively a little more safer, but hey, at the end of the day, it's exposed to the market. So it's got a lot to do with the way the market moves. So do you believe that when SEBI puts forward such regulations to protect the investors, do you think it could hurt the return potential as well? Because it's literally the law of finance, right? More the risk, more the returns.
There are two things to it. What I personally feel here is that when you're looking at debt as an asset class, obviously it is up to the financial advisor or the financial planner who's planning out a debt portfolio for his client, making him understand that once he gets into the capital markets, there is an element of risk attached to it. He's not looking at fixed deposit returns. So that element of risk versus returns has to be injected into the investor's mind. He's getting it in the capital markets with an element of a little bit risk. But who's taking that risk? The risk is being taken by the fund managers. Okay, and here we should understand that the client also now is a very evolved one. So he also knows the differential between a debt and an equity. So he would want a little bit better than a fixed deposit when he gets into a debt product. And equity, obviously, he knows the risks embedded in equity and he's in it for the long haul. But when it comes to debt and when that greed factor overtakes, that all I would say the bad instruments we've seen, the defaults, the downgrading, is ultimately boiling down to one word, which is greed. And that greed has a very, very, I think, cascading effect, which ultimately the retail investor is not ready to take. So I personally feel that, this move has to be taken at a shot. But one more thing is, this is going to be reviewed periodically.
Okay.
So very, on a very cautious note, they are starting it. But it needs to be taken at this stage, I think, at least to, smoothen the process as of now and to tell the investor that the regulator is taking care of it.
Okay, all right. Fair enough. Well, let's kickstart Ask the Money Show. We are going to be answering all your questions and queries. In fact, we've already got our live caller, Kalpesh. Reminder for all our viewers, you can send in your questions and queries or any other queries you have on your mutual funds. The numbers appearing on the top of your screens. But first, we have Kiran, who is calling us from Nashik. Hi, Kiran. Thank you for calling in. Good evening. What's your query?
Hi, good evening. I have invested in HDFC money market fund.
Okay.
So I have two questions. One is because of tightening of regulations.
Okay.
Are the returns going to change of the fund? And question number two is, I understand that because of the repo rate lowering,
that's right,
the liquid fund returns are going to be lower. So does it apply to the money market fund also?
Okay, fair question and very newsworthy questions as well. The SEBI regulations and the decision by, Mr. Patel, so used to saying Mr. Urjit Patel still, but Mr. Shakti Kanta Das actually, to reduce the repo rate. Yes. How does it impact his money market fund?
So once you say, Kiran, the money market fund, obviously it comes very, very lower on the risk parameter and money market funds. And now we have the overnight funds, the liquid fund category. So they are, very much on the conservative side, and also the papers in it are of the shortest duration possible. So, we had the turmoil where even certain liquid funds were affected when the defaults and the downgrades happened. So you will have to check the portfolio of that particular scheme in which you are, the HDFC money market fund. But surely with the regulation and the tightening which we just spoke about, surely I would say the tightening has happened. And it would now, in case, God forbid, it happens, I think the impact will be very, very less. But money market funds are the least susceptible to these type of, problems happening in the debt space. The second aspect which you said is you are spot on, that because the repo rate has been lowered, obviously the shortest duration of funds, which is the liquid, the money market, the overnight funds, their returns would be impacted a little bit, but you are not in this money market fund for a higher return generation. So as per your goal, for what duration you've invested, stay put in it and you can always hope that, once, in case if there is a certain stabilization of the interest rates, the returns on this also would catch up.
That's a very good point, actually, using a money market fund for high return. Given the fact that, like you mentioned, it's lowest when you come look at the risk table, the returns as well would not be that exciting.
It should not be construed as a high return generating.
As a high return generating. So that's a very good point as well raised. Okay, well, keep your questions and queries coming, and just like Kiran, we'll get them answered by Kalpesh. Let's, for now, move on to some questions we have received via email. The very first question that we have has come in from Chinnat Shri Kumar. He writes to us saying, I would like to know which mutual funds have a large exposure to petroleum companies and natural gas for investing with a 5-year perspective. The market values of these companies is at rock bottom, and they have given very good dividends and bonus in the past. Fair enough, yes, I agree. Valuations are rock bottom. OMCs have been all over the place. Brent prices have crashed. Today, however, RIL did manage to stand out for everybody. However, this is where we talk about thematic funds. He's actually looking for a fund that invests in oil and gas, or a sector fund, or a thematic fund. Before we answer his question, do you think this is a good idea to invest in, in a thematic fund?
See, in fact, it is connected to his question.
Okay.
So I'll take it in a combined way. So let's put it that way, that when you invest in a thematic fund, and that would answer the question for Chinat also, that when you invest in a thematic fund, it's an individual call which you are taking on a particular theme. Whereas in a mutual fund, when you invest, you are actually looking at the point of diversification, and that diversification is managed by an expert who's a fund manager. So here you are actually contradicting your own thought process of diversification and being a fund manager or a stock picker on your own. So when you say that this theme is going to work well, it's your own call. There's nobody to help you out there. And coming to the thematic fund, in a portfolio, I think it's a very, very, dicey call that it could be a hit or a miss in your portfolio. So in case if you're ready for that, if you are ready to take that much risk, I would say around a 5 to 10% exposure in your portfolio in a thematic fund is okay. But coming back to this question, how do you time? When you say that I'm ready to stay invested for 5 years, you are talking the language of a normal mutual fund investor who would stay in a diversified fund for 5 years. This is a thematic fund. When would the theme start? When would it end? So you've probably called it the bottom. But how do you know that it is still not at the real bottom, and when would it resurface up, or when would the topping up end? So you need to be very, very smart on your, I think, thought processes, research. And if you are going to do that, I think direct equities is a better call then. If you
also, I think the sector is such that it depends a lot on government policies.
Exactly.
I mean, you never know when
it's a mix of local and international both. So when you say petroleum, you're looking at a very global type of a event. And when you're looking at the local companies which are dependent on that and government policies, you're taking too many calls. And in fact, I would like to point out to the viewers also that there is a certain fund which is a SBI Magnum Comma Fund, COMMA. If you see the overall returns in that fund over a 3, 5, 7, 10-year period, I think it's not encouraging at all. You would find certain spike when, these commodities and these petroleum products would have gone up. But then if you average out for a long term, if you're ending up with a single-digit return, I think it's not really worth it.
Okay, fair enough. Timing these funds, is really, really difficult. You'd rather just be investing in the direct equity markets itself, picking up shares like ONGC, RL, etc. That's rather a better option than going for these thematic funds. All right, Chinat, I hope we've been able to answer your question. Let's move on and bring on board our next query. In fact, it's a live caller joining us, Madhav Agarwal from Jaipur. Hi, Madhav. Good evening. Thank you for your call. What's your question?
Thank you. Actually, we are a private limited company, and we usually keep on investing regularly in low duration funds.
Okay.
In especially like HDFCs and other AMCs.
Okay.
I want to know how safe they are now after this new regulations, when they will start, and especially what will be the impact. I mean, recently we have seen defaults of DHFL and ILNFS, and how they are trading right now, NCDs, and they have a very huge portfolio in some AMCs. I have noticed.
True.
But what will be the impact, and how safe will be the low duration funds in future?
So when you say low duration, I would assume debt, liquid money market, right?
Yes,
Okay, all right. A private company parks their surplus funds in such funds, and I think that pertinent question, how safe is it? Well, I think SEBI has done this to make them a bit safer. And also another very pertinent question, which a lot of MF investors have been having, that with the entire DHFLs and ILNFSs that have really hit the NAVs of a lot of AMCs, how essentially should one go about then navigating through those waters?
What I would suggest here is, being a private limited company, I think the duration which you are keeping your money would be for a very short duration.
Yeah.
So you should be very careful, because if this accident happens and you are caught on the wrong end of the curve, what we've seen is now SEBI has asked the schemes to have a mark to market and complete write-off of that much amount. So you've had 2-3% written off on a particular day from a particular NAV, which is in a debt fund scenario, you are looking at almost wiping out, I would say 6 months of returns. So that can be very hazardous, not only for a private limited company, but for a retail investor as well. So if you're a private limited company and your duration of parking funds is not more than 7 to 15 days, I would actually ask you to shift your money from low duration, in fact, to the money market and the overnight type of a thing, where even the duration is much lesser than the low duration funds, which has a little bit of a higher duration of paper embedded in them.
Okay, Madhav, I hope, Kalpesh's question, Kalpesh's response has helped you out, especially since you're a private limited company and, it's important to use your money wisely, because you never know when you may have to pull out. Okay, we have Mr. K. Prabhakaran from Chennai, who's joining us live on the phone line. Good evening, Mr. Prabhakaran. What's your query?
Madam, I am a retail investor. So I'm going to invest for a little bit longer term for my retirement. So
Okay.
I selected 5 schemes with a portfolio allocation. Whether what I have selected, the allocation is right or not, I want to check with that expert. So I
Okay.
can read out by scheme, by name, madam.
Sure, go ahead, sir.
See, I selected Axis Blue Chip Fund.
Okay.
30% of the allocation to the portfolio.
Okay.
And Axis Focused 25 Fund, Multi-Cap Fund to 20%.
Okay.
And Motilal Oswal Most Focused 35 Fund for 20%.
Okay.
And Mirae Asset Focused Equity Fund for 15%.
Okay.
And the Kotak Standard Multi-Cap Fund for 15%. Whether it is right or any changes in the allocation or fund schemes, I want to check with that expert, madam.
Okay, lots of multi-cap funds actually, and I think there's
Absolutely,
not been a lot of presence of small caps or mid caps. It's for his retirement. Also, Mr. Prabhakaran, how long for your retirement? How many more years?
This is nearly 10 years, madam.
Okay, so 10 more years for his retirement. What do you think of his portfolio?
I think he's made a good portfolio.
Okay.
And only thing, like what you said, there's no small cap fund.
Yeah.
But he could take a call for next 7 to 10 years by a very small portion in the mid cap category.
Okay.
So he could actually he's got almost 3 to 4 multi cap funds, which
Yeah.
is nothing but duplication.
Exactly.
So I would suggest that he just removes one of them. All of them are good, and replaces with a good mid cap fund, because that would give an booster to the entire portfolio returns. And while you're on the verge of retirement, what I would suggest is, which every financial planner would, that while you're on the verge of your goal, which is retirement in his case, is that you start shifting that money, say 2 years, 3 years prior, from equity to debt. So it's a gradual phasing out from risk portfolio to a non-risk portfolio, and then you have your corpus ready. Then you see how you are at the time of retirement, and then you can deploy your funds according to your income. How much income do you require post-retirement? Because then you'll not be working.
Yeah.
So you need to phase that out, because God forbid if you're caught at the wrong end of the curve on the verge of retirement, and if your portfolio drops drastically, I think you will be really in a bad shape. So your portfolio constituent is good for right now. Just replace one multi-cap fund with a mid-cap fund, but keep in mind the duration, because mid-cap funds come with a lot of volatility, and you will find a lot of, I think, ups and downs in your complete portfolio. But stick to the course and stay disciplined.
Well, for now, mid-cap funds have already gone down quite a bit.
Yeah,
So you may
yeah.
be able to pick up more units in the same, amount that you would be investing. But yeah, maybe remove one multi-cap fund and, replace it with a mid-cap fund. And of course, very importantly, as you approach retirement, cull down your equity exposure and bring it more towards debt, because it's a more stable source of income as well. On that note, we will have to close Ask the Money show. Our phone lines will be shut now, temporarily, of course. We will be back in the next segment with a realty discussion. But Kalpesh, thank you for joining in and very patiently answering all our viewers' questions and queries. That's all on this edition of course, mutual funds. But here is, of course, the TMS Savings Challenge. What exactly does this entail? Well, it is all about saving money, because remember, to get rich, it's not just enough to be earning a lot of money or investing your money. It's also important that you save your money, and you can do so by everyday simple methods. Like, for example, deciding to take advantage of this lovely climate and going for a jog, or doing yoga instead of going to the gym and paying those expensive fees. The most innovative method of saving money will be featured on The Money Show and on ET Now's social media handles. So folks, start saving and tweet to us, and of course, enjoy the joy of saving money. Everyone, welcome back to The Money Show. Just before the break, we were talking about the new rules that SEBI has come out with. They seem to be coming out with them very, very frequently, but it's all in an attempt to essentially protect the retail investor, that's people like you and me, from being very greedy. But now let's talk about another very important announcement from the Supreme Court. Home buyers now are officially maintaining their status as financial creditors. It's a very important role that has been attributed to home buyers, especially those home buyers that have had their money stuck in various projects that do not seem to be budging. I'm talking about Amrapali, JP, 3C, Unitech. All of these builders have actually not been able to complete the projects, much to the detriment of the home buyer. But the Supreme Court now, of course, has given a fillip to the home buyer. So what exactly does it mean? And as a home buyer who has not received his or her home, what are then the available avenues for you to complain? For that, we have with us Prashant Thakur of Anurag Consultancy. He, in fact, joins us right here on The Money Show in ET Now studios. Prashant, thanks so much for joining us on ET Now. It's a very important verdict, and you know, a lot of media houses were really celebrating the verdict because it was in the favor of the home buyer. Officially puts them on the same footing as perhaps the other secured creditors and the other financial lenders. But a lot of our home buyers may not be understanding this whole financial creditors and, you know, jargons like that. So first, if you could explain to our viewers that the fact that you've got this tag of a financial creditor, what sort of rights does it give our home buyers?
You know, so before we take a deep dive into the verdict that has come, let us understand the magnitude of the problem that the home buyers were facing.
Yeah.
So as we speak, you know, close to 1,77,000 projects in India, tier 1 cities, are stuck, totally stalled. And you know, if you total up the market value of this project, these are close to 1.7 lakh crores, which is a huge sum. And you know, the irony is that these stuck projects, 65% of the projects are already sold. That means the home buyers have you know, paid the money for their homes from the hard-earned money, and they don't see anything moving on the project side.
So that means 1,77,000 crores, and 65% of that is already
already sold. So that's a huge number.
Yeah.
Now, if we look at the other aspect, now close to 350 developers are already under NCLT. That means the process of insolvency has already been started.
Yeah.
And the way this industry is behaving, I think many more developers would follow the suit. And in this context, if the home buyers has no say in the process of formulating the resolution plan, or let's say he has no claim on the money that is generated out of the bankruptcy resolution. So that was kind of, you know, pretty unfair on the home buyer's part. Now this Supreme Court ruling clearly states that the home buyer is now at par with the financial creditor. That means he has equal amount of say as a particular bank would have. So, you know, if in the absence of the status of a financial creditor tag, the home buyers were left at the mercy of the resolution professional, the bankers, and they had absolutely zero say. And they had no, claim on the money that was generated. So it was an irony. Me as a home buyer, I have spent my hard-earned money on booking the flat, and there's no fault of mine, and then the developer has kind of not delivered. And yet I have zero control on how do I take that developer to justice, and how do I claim the money that is being generated. So it's a good move, and it's good for the industry itself. The reason the industry is going through a slump is because there's a huge vacuum in terms of the trust deficit, and such kind of rulings from Supreme Court and in government will bring the trust element back into the market. So I think this is a good move for the home buyers, and pretty soon we'll see some kind of further consumer centric rulings coming out from the government end and then the Supreme Court end.
But Prashant, as a banker, as any other secured financial creditor, I have my army of solicitors and law firms, etc., to adequately represent my interests at the NCLT courts or during the IBC process. So realistically, for a home buyer who's your regular individual, if they've got a financial creditor status, that means they too technically can take the home buyer to the courts.
Developer to the court.
To the courts and say that, hey, this guy is bankrupt. But if realistically, if I have to give that option to my viewers out there, is it really feasible from a financial perspective for them to involve themselves in the entire process?
See, for a home buyer, I think that would be the last resort.
Yeah.
Now, if we look at the option that a home buyer has today, RERA has provided a first line of defense. For example, now if I'm buying a project which has a RERA registration number, so that gives me a first line of, confidence that this project has at least got RERA registration and all the paperwork, all the approvals are in place. So that is first part. So for a layman, I'd not look at anything else, but, I would go for the RERA registration number. Unfortunately, if the developer has kind of defaulted again, I have an option of going to the RERA appellate court, which is a very simple process. You just need to go online and file a complaint.
Okay.
And I think most of the complaints gets resolved at that instance itself.
Okay.
Unfortunately, if it moves to the NCLT, then I think there are forums, there are kind of owner association who are kind of they can form a group and then they can approach the NCLT court. But again, having said that, that's the last resort, and none of the genuine home buyers would like to kind of resort to that.
Okay. Yeah, genuine home buyers. That is something that the Supreme Court as well mentioned. But that's, I suppose, a topic for a different day. The other question I had to ask you is, let's say if currently we do have a builder that is already in the midst of the entire IBC process, the resolution process. So I, as a home buyer, as a financial creditor, what are my rights over there? What can I do if my builder is already at the IBC courts?
See, for example, if my developer is already in the IBC court and, let's say as a homeowner, I have a say in the resolution plan.
Okay.
Now, for example, it says that 75% of the consent is required. So, I as the genuine home buyer, if I feel that, the broader lender group is progressing in the right direction, I can give my consent.
Okay.
If in the absence of such a say, the buyer had no clue what is going on. He would, had absolutely no hand in how this entire resolution plan is being evolved. Because what would happen, the financial creditor, banks per se, would be more interested in getting their money back.
True.
It would be, seldom a banker would be more interested in kind of, getting the home buyers his due first and then kind of claiming the money.
Yeah.
So me as a home buyer, has, the say in when the entire process is being formulated, and also will get the money, when the liquidation happens, I will be sitting at par with the banker. So bank, along with the home buyers, would be the first claimant to the amount that is being generated out of the auction that is process that is being happening.
So does it mean that for a home buyer, I mean, during the process, without the home buyer's consent, the process cannot go through? Is that, would that be correct to say?
No, for example, let's say if in the absence of home buyer, for example, let's say if the home buyer group, if he's not giving his consent, and let's say, for example, a couple of them have given and it crosses the 75% threshold, it will go through.
Okay, all right. So it's not that if the home buyer does not give, the process will be stalled.
No,
okay, that's very important to note. Don't go around in the NCLT court saying, I have not given my approval and this cannot go through. 75% of the total financial creditors,
Yeah, that
regardless of
includes,
the
yeah.
category. You're a
Yeah.
banker, you're a financial institution, you're a home buyer, has to be given consent. So it's all the more important that, via a group of owners, home buyers, rather, you represent yourself adequately. And of course, you have RERA, Consumer Court, IBC. This is the last option. I guess that's why it's right at the bottom as well.
IBC would supersede in case of conflict.
Okay.
So I think IBC would supersede. Now, for example, no one can say that your case is already under RERA. You cannot come to IBC.
Okay.
In case of conflict, IBC would supersede everything.
Okay, all right. So IBC is the top authority
Yeah.
basically over there. Now, the other point that I wanted to actually discuss is with respect to the government's looking at setting up a stressed fund. I know it's still in early stages. I mean, our housing minister is actually looking at something like that, a stressed fund. What exactly would that entail? I mean, does it mean that the government is now going to come and bail out individual housing projects?
No. That's not going to be the case.
Okay.
But again, let's understand that the stalled project that I spoke about, close to 1,77,000 or 74,000 odd projects. So these projects are stuck at various ends.
Okay.
Few of the projects are stuck because of lack of fund, where the developer kind of ran out of the fund. Few projects are stuck because of some approval issues. Now the problem with this stuck project is that nobody is aware that how much money is required. Government tried to include or bring on board a lot of private developers, but everybody was hesitant because nobody had a clue that how much of money is still left in the project. Now, for example, let's say there are certain cases where developer has spent more money that has been collected from the developer. That means even if I come as a developer to complete that project, I'm not sure whether I'll be able to make the money or not, because the amount that developer collected on that project, he has kind of spent it on other projects, buying land banks, and that's the reason the government needs to step in, because none of the private developers are coming in. So what does government intends to do with a stress fund? So government would the proposal is that government will set up a fund where government will bring in some equity that would give some credibility to that fund and encourage few of the private developers to come on board. So government might give some kind of 25% of money for that fund, kind of assure that the approvals will happen. All those certification, OC and CC would be granted if somebody is coming on board, and the developers would also have some kind of incentives in terms of additional FSI. He would have first right of buying the land parcels of those stressed developers. So that way government is trying to incentivize the private sector, or let's say the developers, to come on board and complete these projects.
Yeah.
Because till the time these stalled projects do not move, I don't think the consumer sentiment is going to come back anytime soon. And if the consumer sentiment is not coming, I don't think the cycle would start to move. So that's the catch-22 situation we are in right now.
Well, a lot of reports are saying that the finance ministry is actually, having a lot of discussions with realty companies to revive all these stalled projects. And speaking of stalled projects, or rather projects in trouble, Amrapali, that's one of the most highlighted cases, I think, for real estate companies. I think it's going to go down as a case study, I suppose, for the industry. And right now, the Supreme Court has asked, in fact, that registration must start for flat owners, of Amrapali. Firstly, I mean, it was a very difficult process. It was a very lengthy process. What do you think were the key mistakes made in Amrapali? And if our buyers are now, our viewers are looking to buy realty projects, how can they ensure that they do not fall into a trap, Amrapali-like trap?
I would not say that the buyers were at fault.
Okay.
The era where where they made that these purchases were kind of different. They did not have anything called RERA, and the market was kind of more of a speculation driven, and these home buyers kind of got carried away. But now times are different. We have RERA. Now, for example, if somebody has to make some kind of purchase decision right now, I would advise the first thing they should do is to go on the RERA website and check for RERA number. Okay. If that project has a RERA registration number, that means the first round of check is already done. The project has all the approvals in place, and the commencement certificate would be in place. The second additional thing that the buyer should do is that the buyer should go a step further and check for the financial strength of the developer. Look at the past project that the developer has executed, the number of projects that developer is currently executing. That would give the buyer some insight on the execution risk that the developer is carrying on. And there are various portals, there are various kind of a blog post where you can go and check for the feedbacks of the existing buyers. So you need to kind of do a 360-degree analysis on your own. Do not just rely on RERA. RERA will definitely give you a certain confidence, but do your own due diligence by going to the developer's website, checking its financial credibility, checking for its past projects, and then the number of projects they are kind of executing right now.
Okay, all right, Prashant. Thanks so much then for that complete A to Z, especially with respect to the new, judgment by the Supreme Court. A home buyer is a financial creditor, and he or she can get their voice heard at the courts when, of course, the IBC or the resolution process is on. Well, with that, we will have to put a pin on the Money Show until tomorrow, 5 p.m. We have the CPI data that is released. We're going to be discussing that right after this short break.